If you think that markets are marching back to some new all-time highs, you better watch where you step, because the chart master says there could be a giant trap out there. They call it the Admiral Akbar trade. It's a trap. Carter Worth is over at the Plasma to break it all down. Carter.
All right, so they're new traps, and they're traps that's just been trapping and trapping and trapping, and that's what this is. The industrials are the trap that keep on trapping. The sector, as you know, is 9.2% of the S&P, 70 stocks, 2.5 trillion. But more importantly is what have they done? And the next chart after this table will tell us that. But on a 10-year basis, industrials have outperformed the market in 3 of 11 years. That's pretty shabby. And they have underperformed, right, the market in totality or cumulative. So what we know is a higher beta area of the market that's given you a very low hit rate and is not kept up with the market, and adjusted for risk or beta, that makes it even worse. This is a highly cyclical area of the market. Now take a look at the chart, and this will really make the case. This line I've got here, that circle, that is the presidential election. And what you had was the Trump bump. And Wall Street, in its infinite wisdom, promoted industrials and cyclicals as the way to prosperity. And what we know is exactly the opposite. This has been underperforming the entire way. So yes, they're up, but the choice of picking that versus the market has been an unmitigated disaster. And in fact, we are flirting with new 52-week relative lows and 9-year relative lows. That's not a good setup. Moving on. So here's the industrial chart itself. I mean, it wants to break out. Yeah, in fact, look at this line. It has tried to break out, and just recently, it in fact pushed above that ever so slightly, and yet it was rejected. Now, the real risk, of course, is that it ends up being something like this. No one can know that, but what we do know is on its most recent attempt to break out, it has failed. Finally, let's look at the XLI, the ETF that you can use to trade this. Now, this is a very precise sequence. An uptrend and a break, down 8.9. An uptrend and a break, down 8.7. An uptrend and a break, down 7.8. And what's just happened here? We get a nice zoom. We have just broken again. Does it have to go down 7 or 8 or 9? No, but it's a pattern, and the sequence calls for lower. I think you sell industrials, and they haven't been working anyway.
No, G's a big part of that, of course. Carter Worth, why don't you come on over, guys? Let's trade this.
Well, before Will is bringing Carter its chair in, this is Will's last week.
Oh, this is
Last week, so you know. See, there's.
I just tweeted him out, man. He looked good,
where there's a way, there's a will.
Pedro, where are you from? What state are you from?
Great state of Minnesota.
Sinnesota. So Triple M, Minnesota Mining and Manufacturing, was a $270 stock in January of 2018. It's down 35% since then, with now the S&P effectively trading an all-time high. And in my opinion, still expensive on valuation at close to 18 times. So I'm sort of in the Carter camp. Yes, Triple M has bounced a little bit, but the trajectory has been lower for most, if not all, of these names.
And I think China's hurting them as much as anything right now, right?
Well,
I mean,
it's
that's
case
their
by case. I mean,
exposure.
there's not to say you can't own industrials. Ingersoll Rand looks great. Dover looks great. Some people like the rails. I don't. Some people are going to try to bottom fish and maybe find a GE. There's nothing wrong with that. But in aggregate, I think the irony is that this has literally been a drumbeat year after year. And it'll happen again. In January of this year, sell-siders will promote this area of the market because of PMIs or whatever. Well, maybe. But as of now, every January, it's the darling, and every year, it's a dud.
Well, it is to the tariff point. I think the guy's point, Steve. I mean, we always talk about retail getting hit by the tariffs. These companies have massive industrial inputs. This might be the group that no one talks about because it's not sexy talking about, ethylene and things like that. But this matters when it comes to the tariffs.
It does matter, but to the bigger message I think I got from Carter there is that do I wind up just buying the tech names? Do I wind up just buying the consumer discretionary names? And what happens to those names? Because longer term, I think you're better suited just overweighting there, right? Instead of energy, instead of industrials. But the last question is, what happens to those top sectors in January when the industrials are getting hit? Do they get hit less?
Who's to say the industrials are going to get hit? But I think the point is, you've got to pick your right stocks because thematically, this is, while popular, not been right to do. And I think you see it in industrials, not only that, but materials. You see it in energy. And so does that mean you just crowd into tech? That's the market's risk, ultimately, that a game of musical chairs is being played and that fewer and fewer chairs are the right place to be until those give way as well.
Yeah, and this is a group, by the way, the industrials, the way the S&P groups them. American Airlines is in there, FedEx, hardly industrials. Copart, by the way, up 84%.